Good morning. My name is Miguel Gonzalez, and I'm a certified retirement counselor with over 20 years of experience helping clients in retirement income planning, overseeing investment of funds, and designing retirement plans. This week, let's talk about the pitfalls of market timing and the importance of staying invested for long-term success in the stock market. Market timing is a strategy of deciding when to buy and sell stocks by attempting to predict which way and when stocks will move. Let's look at an example and the data to determine why market timing is unwise. First, timing stocks. Let's say that I was convinced that Bank of America would rise if Clinton had been elected president because Clinton was real cozy with Wall Street. As such, if Clinton had been elected, I would have placed an order to buy Bank of America stock on November 9th. The other side of my logic would make sense to this timing strategy too. So conversely, I would have predicted that Bank of America's stock price would fall with a Trump victory and therefore would sell Bank of America stock if Trump had won. Notice, I did not think about Bank of America's balance sheet, their cash reserves, their earnings, or anything else. I'm just convinced that I know the direction their stock price will move and when. Sounds simple? Maybe even logical, right? Well, guess what? Bank of America's stock price went up about $1 after Trump was elected. But now let's talk about timing the markets. In addition to trying to time individual stocks, some try to time the direction of the stock market with precision. Let's use an example from not so long ago. On election night in 2016, markets around the world were falling as Trump racked up electoral college votes. In fact, Japan's markets were off by about 5%. Mexico's peso was getting hammered, and the U.S. futures market was down by about 800 points, pointing to a real rough day for the U.S. stock markets when they opened on November 10th, or at least that was the prevailing thought. But the markets ended November 10th up over 1%. So if you had bet on the market losing ground on the day after election, you would have lost money, maybe even a lot of money, because you guessed the direction wrong and missed the 1% gain. That is why some liken the market's timing to gambling. Here's some empirical research. Have you ever thought about the real impact that trying to time the markets can have on your returns? In a recent guide to retirement study, JP Morgan Asset Management demonstrates just what happened to one's returns because they missed out on most of the good days. And the results are staggering. According to JP Morgan's study, if you stayed fully invested in the S&P 500 from 1995 through 2014, you would have enjoyed an annualized return of 9.85%. But if you tried to time the market and ended up missing just 10 best days during that period, your annualized return would have been only 6.1%. In real dollar terms, a $10,000 investment would have been worth over $65,000 if you would have stayed fully invested. But if you missed the 10 best days, however, that same $10,000 was worth about $32,000. That could be a significant down payment on a house, a college education, or a fancy new car. Does this grab your attention? Need more proof? Okay, let's go back further and look at more data. A study commissioned by Tanoli Capital Management and conducted by Professor H. Neha Sehun from the University of Michigan analyzed 7,802 trading days for the 31 years from 1963 to 1993 and concluded that 90 days generated 95% of all the year's market gains, an average of 3 days per year. Can you imagine if you were out of the market on those 3 days each year? Further, Professor Sehun found that between 1926 and 2004, more than 99% of the market's returns were earned during only 5.1% of the months. And for a 42-year period from 1963 to 2004, scant 0.85% of trading days accounted for 96% of market gains. In conclusion, the data concludes that unless one can perfectly predict the future, you might be better off being invested. But before you say, well, I'd never try to time the market, I want you to think about this for a second. Have you ever postponed funding your investment account or making an investment decision until the market picked up or until the market settled down? If so, you've engaged in market timing, and that's unwise. Once again, this is Miguel Gonzalez with Cortburg Retirement Advisors. Please take a moment to click the like icon and don't forget to subscribe to my YouTube channel to receive our weekly video podcast every Monday morning. Thank you for watching, and I will see you all next week.